Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we bring in a minister or a CEO or in this case the finance spokesman for the Labour Party, David Cunliffe. Welcome back to interest.co.nz.
Nice to be back. Thank you.
Well, in the last few days the Prime Minister has come out and said that the budget on May 19 will be, he quotes, a zero budget. Essentially the government is going to cut spending in some areas and spend it elsewhere, not increase total spend, in part because of the shock from the earthquake. He doesn't want to increase borrowing too much. What's your view on how government should respond to the earthquake shock?
Retrenchment in the middle of a recession is typically regarded as what not to do because you make the recession worse and it goes on for longer. People lose confidence, they close their wallets and businesses don't invest, and it can become a doom loop. Now, even before the tragic second earthquake in Christchurch, it was clear that we weren't going to get much in the way of economic growth this year, and NZIAR and Treasury are both saying that over half of the reason for the write-down was preceding economic stagnation. So the economy needs a shot in the arm, and it needs a game plan to get it out of the rut and to a more productive basis, and that will take some investment, and it will also take some demand. So a zero budget in that context, I would argue, is a very, very dangerous thing that is likely to prolong the recession even further.
But wouldn't you have to get the money by borrowing, and wouldn't that increase interest rates for everyone?
Well, the government's basically got three broad options in the face of a terrible disaster like Christchurch. It can either borrow the lot, which Bill English initially said that they would do, it would all go on the plastic. They can cut to offset the expenditure. Interestingly, Mr. English said they would not do that because it was an upfront one-off cost that was nobody's fault, that could be spread over many years. So on the face of it, the Prime Minister's comments seem to contradict his finance ministers. They could reduce spending, or they could, of course, increase revenues in some way, or some combination of those. Now, we're studying this question hard ourselves. We're going to come forward shortly with our view on what we should do, but let's just say that borrowing and cutting without recourse to any form of revenue enhancement to cover the costs would be seen as unusual, I would imagine, by international standards.
So do you think we should bring in a quake levy?
Well, I think we haven't released our position yet on that, and we're actively considering a number of options, so I'm not going to announce it online today. But what I would say is that it's a very unusual circumstance for a government to try to put a cost like this on the plastic or to try to cut its way out. And, you know, I wouldn't mind betting that most New Zealanders, no matter what their station, would accept some kind of contribution of some duration through the tax system, and they would probably want to have a discussion about how much for how long. But, you know, the facts are the government's given back $22 billion in revenue through the tax system in Budget 2009-2010 over a 4-year time period. That's money that could ill have been afforded beforehand, and it's an even more dicey proposition now, I would have thought.
But if you imposed an earthquake levy, wouldn't that give the economy the same demand shock, if you like, pulling money out of people's wallets and therefore depressing the economy in the same way that spending cuts would?
Well, not necessarily. For a start, demand out of one part of the economy which is reinvested in another ought to be zero sum, all things being equal. And secondly, what the government's talking about is cutting expenditure as a substitute for any form of revenue enhancement, which of course is a demand shock as well. So I think the literature is a bit divided as to which has got the bigger multiplier, but the Keynesians certainly reckon that well-placed government spending has a bigger multiplier than a tax cut. And so on that analysis anyway, well-placed investment with some revenue enhancement couldn't be ruled out.
Now, the Reserve Bank has just cut the official cash rate by 0.5% to 2.5% after the earthquake. Yep. What's your view on that cut?
Well, I saw your commentary and I saw the reaction of people in the room. And I think the majority view was that it was a prudent form of insurance for the bank to lower rates in the short term. The concern is, of course, that if we get an oil shock on top of the earthquake, that the bank might be in the position of having to back it out pretty quickly to avoid a second-run inflation problem. And, of course, we're going to have the inflationary impact, at least regionally in the South Island, of a lot of rebuilding activity from 2012 on. Our analysis is a little bit sceptical about how quickly that's going to come to pass. We think that the bank's got a bit more breathing room probably than your commentary suggested, Bernard. And we think the bigger problem at the moment is the one I alluded to before. As far as New Zealanders are concerned, they can't see the plan to get out of this mess. Ordinary Kiwi households aren't saving, they just have no money. You know, they're just seeing the cost of going to the supermarket or to going to the doctor or putting petrol in their car going up faster than their wages. And so they aren't spending, businesses aren't investing, retail's as bad as it's been in a decade. And the so-called boost from dairy prices just doesn't seem to be flowing through yet because farmers are deleveraging. And that ends up with an economy that's in a rut and people wondering how on earth we're going to get out of it. And from my perspective, as a Labour finance spokesperson, another round of retrenchment when the economy's already in a rut is not the first place that you would start.
But aren't your constituents those people on rents or maybe retirees who are receiving income from savings? They're the ones who are going to see, if inflation takes off, a jump in their living costs. And as we've seen with the cut in the term deposit rates after the official cash rate, a drop in their fixed incomes.
Well, it's certainly true that for retirees who may be bolstering their income with interest-based savings, that will be a real cut to income to them. There's no doubt about that. And for some people, that will be an additional hardship. But monetary policy has never been run as an income supplement for retirees. That's not the brief that the Governor has. He's got to balance the need to absorb a hopefully one-off major shock to the economy, which is 10% of our GDP, with the inflation outlook and still manage to the objectives of the Reserve Bank Act. Now, we've had a separate discussion another time about whether we think the Reserve Bank Act's objectives are appropriately couched or whether that's a little bit archaic given the way the world's moved. We think it needs a bit of an update, but I can understand why he's done what he's done.
Any views then on how the Policy Targets Agreement or the Reserve Bank Act should be changed? Any update there?
What Labor's saying has been quite consistent, I think, for about 18 months now, which is that by limiting the bank to a sole focus on inflation, in theory, they make the Governor's job harder in practice, because in practice, he's got to be closer to the Reserve Bank of Australia's framework, which has to balance a primary inflation objective against secondary objectives of growth and employment. And here, of course, he's got an objective which is, how the heck do we cope with the Canterbury earthquake? That's not an inflation problem. So it's, technically speaking, arguably ultra vires of his act, which is why we think the act needs broadening and the PTA should follow.
Now, the government is also bringing through some changes on telecommunications. We've been waiting for a broadband plan for a while.
Yep.
What are you seeing inside the government's negotiations, changes to the rules around particularly telecom?
Well, as we're going out to your viewers and the very active internet.co.nz website, I imagine people will take a bit of an interest in this because disaster is coming down the track, and I'm not exaggerating. We had, when I was Minister of ICT, several hundred major ultra-fast broadband projects in bankable form with subsidies approved, ready to get them over the line, and I held them up going out the door because of the Constitutional Convention that I was so close to the election that the incoming minister, if there was one, should get to sign on the dotted line. So I did that, thinking he'll pick and choose the ones he wants and that'll be Bob's your uncle in a few months. 2.5 years later, not 1 centimetre of fibre has been laid by this government. It is extraordinary. They didn't have an ICT policy. Stephen Joyce had a slogan, and he didn't know how to implement it. And when they tried to apply a commercial rate of return to their $1.5 billion through Crown Fibre Holdings, they had 2 problems. Number one, Crown Fibre is arguably conflicted. How can it be a frontline regulator and an investor at the same time? Second of all, 1.5 with a required rate of return, commercial rate of return, wasn't enough to get the stuff up. So that is the problem that Mr. Joyce is now trying to fix by essentially what some people have called a legislative subsidy to the likely incumbent if structural separation of telecom goes through, i.e. the law is written so loose so badly on any one of about 24 dimensions that I could bore your listeners with, that I'm afraid we could be back to the bad old days where the fox gets let loose in the chicken coop, and that would be bad for wholesale competition, it would be bad for broadband, it would be bad for consumers. And, you know, I'm just terribly worried that we've got a tragedy waiting to happen here.
So what could the government do differently?
What the government could do differently would be to build upon the bipartisan consensus that has existed over the last 5 years at least, where Maurice Williamson had the good grace to say, we got it wrong, let's be part of a pro-competitive market framework, let's have a regulator who's up to the job. For God's sake, the current government wants to send the Commerce Commission on a regulatory holiday for 10 years. I mean, how smart is that, given that the speed of technology movement in this sector is incredibly fast? That might be 4 generations of technology. Crazy. So we wouldn't have a regulatory holiday, I shouldn't imagine, and we've got some further announcements due about what our policy will be in this area, so watch this space.
Great. David Cunliffe, Labour's finance spokesman there, talking in another in our double-shot interviews on interest.co.nz. I'm Bernard Hickey.
Thank you.